What is going on, Hot Take Nation? It is DRW here for another episode of the Hot Take of the Day podcast. Not surprisingly, it has been a while, and one of my absolute favorite people, because he sees the world like me, but he's just so much smarter and better looking, it's hard to imagine. Mark Rossano is back on the show. Mark, how are you today?
Oh, well, thanks for having me. It's always a pleasure to talk shop and to go through some of the fun things that we've been talking about on the side in terms of the unknown in the market with all those fun data points.
So for those who don't follow Mark, first of all, you really need to. So he puts out 2 or 3 episodes a week on a really data-driven dive into what's going on in the world, oil, economy, EIA data, the Three Gorge Dam. He's about 3 weeks in front of everybody else in the world, it seems, around things that matter. So really smart guy. I'm not just saying that, I truly believe it. So let's start there, because the things that go on in the background that people don't know is every time the market goes up 3% in a day and there's absolutely no reason, I call Mark and I go, what in the hell is going on? This makes no sense. And we both pull our hair out for about 45 minutes. We go through all the data. We convince ourselves that we are right, that you should be short this market, but you can't be short this market. And then it continues to go up. So this morning they released the unemployment data, which was better than expected, and unemployment, and I put this in air quotes, dropped below 10% for the first time since coronavirus. But there's this shadow number. Mark, walk us through how you saw the numbers today.
So, like when we look at some of the just pulling them up now, when we look at some of the non-farm payrolls and we look at the private payrolls, the non-farm again came in with estimates. Things look a little bit better. I look at this a little bit differently and say, okay, well, what's happening with manufacturing? What's happening with underemployment and labor force participation? Because I think those are the ones that need to be looked at the most right now, given underemployment with people who are furloughed, may have gotten laid off and are now doing short-term part-time work. And then what is that participation rate? Like, how many people are sitting there saying, look, I'm furloughed. I'm making 30% of what I used to make, and my childcare costs are going up, and I just have to leave. Like I can't afford it. My kid isn't going back to school full time. They're going to be they're going to be doing this Zoom remote, and they need my attention. And all of a sudden, you get these shifts. So when you start looking at it, you have to start focusing on what those key pieces, and then the manufacturing, because really we have to understand what is happening at the consumer level, what's happening at the supply chain level, and how are these manufacturing jobs coming back. And because even though we've seen PMI come in really pretty good, we've seen some of these nice things starting to turn, but employment continues to lag. And that is, I think, the bigger component when we think about, okay, well, how quickly can we turn? How quickly can we get that V-shaped recovery? How quickly can GDP really bounce if we have a weak consumer?
Yeah, and it's interesting. We talk about unemployment, and you've told me a story about someone who shall rename generic, but it was sort of at a large hospitality organization, won awards over and over again. Talk to that story in generalities, because I think, again, there's like this macro data that people want to look to and point to and use as evidence for something, but then when you look at the actual stories and you think about the actual industries that are being impacted, and none of them have really seen the job losses, permanent job losses that you would see. So talk about that.
Yeah, it's one of those things where this individual was doing very well, been with the company for 22 years. And this is why we always talk about, or I always try to highlight the fact that this really started in 2019. Like, we have to look at what happened in 2019 when the data started to roll over. And this individual was talking about how last year things started to get a little soft. Things started to get a little bit weaker. Now, the hotel that this individual was operating was still breaking even, making a little bit of money. It wasn't like it was going in the red yet. And then 2020 happened, and things really started to turn over in January, February, when, just based on the climate, this should have been a peak time for revenue in terms of what was happening. And then COVID hit. And then everything just continued to accelerate to the downside, but was already rolling over and showing the cracks. Now, this person has won several awards, some of which can be, because again, it's the hotel, what does the staff look like? But there are things that can be attributed directly to the individual. And then they got the offer, here's 22 weeks and 50 days vacation, and this is your buyout. Take it and walk off into the sunset, or hang around and maybe you get something that's a little less later on, or maybe we can place you somewhere else. And these are the real data points when you start looking at it, because this is not a person who's getting paid hourly. This is not a person that's getting paid a small number. This is a real job that puts you in the upper middle class that is going away, or at least getting removed. And that's why when we look at manufacturing, when we look at some of these key data points, you have to appreciate, well, were they relevant in 2019? Like, are people just sitting there saying, oh, I'm sorry, COVID, because this is now an excuse to let people go? Because before that, you needed reason, you needed just cause. You didn't want blowback because of age or race or any of those issues. So you had to build a case for these layoffs. Now you have an out. Oh, it's COVID. I'm sorry, that's
Right.
COVID. And that's the problem.
So we look at I always laugh. Well, I don't laugh because it's actually sad and tragic when you think about it. But every week we have new unemployment claims near 1 million, over 1 million. This week was under 1 million for the second time in 3 weeks. And everyone is pointing to that as, see, look how good things are. And I'm like, well, that's the initial jobless claims. I mean, there are only so many people who can file the initial jobless claim every week. Like, we're literally running out of people. The shadow unemployment rate, I think I read, was 14.8%. Mm-hmm. So that's the real. So it was 8.5% ish was the unemployment rate, but that excludes people who aren't looking for jobs. Right. Now the shadow would be 14.2. Do you, based on how you think about the world before we pivot to energy, do you think that the unemployment rate climbs towards the election, stays flat towards the election, or continues to decline towards the election?
I think it starts to flatten out, because I think now we're getting to a point where a lot of anyone that had some small business loans that were still available, some PPP money that was still available, that's now all gone. So now you're starting to see some of these individuals and companies that were thinking, oh, things are going to get a lot better. Like, I'm just waiting for Q3, like just wait for it. And now we're in September. Things haven't gotten that much better. They're starting to get a little bit worse. They're starting to get even more headwinds. Again, coming back to that consumer spending, and now you're starting to see some of these new furloughs or these new announcements of another round of layoffs, and that's really creating the issue. So I would say that we have enough right now in terms of the back and forth to say unemployment stays here. Let's call it like it came in about 8.4%. Should it say between 8 to 8.5%? Sure. I think the bigger issue when you talk about that underemployment rate, which came in at that 14.2, I think that could get higher. I think you could start to see that creep up into the election as people start taking some of that short-term work, starting to just try to find some way to close the gap, because there are a lot of families that build budgets around 2 salaries. And now if you have 1 salary or 1.2 salaries, you're going to have to make it up somehow. And I think some of those things are going to start to show up in that shadow number.
So let's pivot and talk about the EIA. One of the things that you and I think you and I were amongst the early commentators to identify that one of the key issues coming out of COVID was going to be inventory levels. Yeah. And you talk about it on your show all the time. It's always hard to pin down exactly how much oil is out there because of the way that production cuts are done and tankers are moved and not moved, and where is all the oil. But when you look at the EIA data and when you look at oil prices, it says today, down a bit from where it was, 43, it's now around 40, 41. What do you think? Why is oil still anywhere near 40? I really believed it was going to head back to 32, 33 going into Q4. And we have been quite sticky around 40. I'm curious your thoughts.
So there's 2 things at play that have really been a big driver. And one is, people have been talking about it and we've been highlighting it about, the Saudi shift. You have, everyone looks at the EIA data. It's the most comprehensive. It's the most complete. It comes out weekly. So you can really kind of project something into the market by cutting exports, trying to pull down some of the storage and making some of those moves, which we've seen with OPEC really kind of turning away from the U.S., trying to all of a sudden, shifting into other markets that are more opaque, if you will, specifically China, India, and other parts of Asia.
Now, before you go, so there was an article on Bloomberg that said that the Saudis have reduced exports to the United States, and that was this week, but that's been kind of consistent. Talk to me about this opaque trends, like the actual strategy behind what Saudi's doing. It's not price related, or it is price related. What's the exact driver on the?
So there's two different things, and it comes down to price, and then in terms of market share. So when you look at the pricing levels, you really weren't getting the premiums that you wanted coming into the U.S. And to be fair, the U.S. wasn't really a buyer. Like if you look at the refining complex, we've been struggling to just to break above 80, 81, and then really stay there. And now you had Hurricane Laura come through and knock us right back down with little reason to go back up. So it's not only just Saudi shifting, it's also the way refiners are purchasing. And if you look at the way refiners were purchasing, all of a sudden it really didn't make sense because we had so much oil in storage. You had refiners that took advantage of that huge price drop back in March and really into April, where they bought a huge slug of Saudi Arabian crude, and then they put it into tankers. So now you have to really work that down ahead, like really before you can do anything else. Now, in the past, Saudi would want to kind of maintain a relatively stable flow, but they're sitting there now and saying, well, there's no real reason to flood this market anymore because we saw what happened the last time we did it. Well, let's turn to a different side and let's see, where is Russia sending crude? Where is Angola? Where's West Africa sending crude? And how can we start to get more market share from some of these levels? And that's when you start looking at China, you start looking at India. And let's be fair, the US has really hit a plateau when it comes to daily activity, coronavirus impacts in China. For the most part, I mean, we can question their data, which I do on a regular basis, but they've seen some uptick in terms of just demand, and that's where you're seeing some of that Saudi crude really kind of develop and really kind of push into, and that's hit Angolan exports, that's hit Nigerian exports, and that's where you're starting to see this battle back and forth, and the battleground is Asia, and it's much harder to track Asian flow versus a well-defined, U.S. EIA type structure.
Okay, so how about compliance? One of the things that you always talk about, pardon me, OPEC has cut production, but then the compliance has been poor, or that, the compliance was like, well, I know we didn't quite meet our targets this month, but I promise you in September, October, we're going to do it. How has compliance been, and where do you see current world supply, like in terms of the total number of barrels a day, both being supplied to the market actually, and then what's the supply capacity? A lot of people have been talking about the declines that you and I talked about at the end of 2019 and continued to believe that we were not going to see growth in the U.S. well before coronavirus. The EIA data shows very definitively November 2019 was peak oil. We had 5 months of decline before coronavirus. But people are now saying, well, the U.S. is going to decline 4 million barrels a day, and that's so big that the world will be short crude, and Goldman Sachs comes out with a $65 target next year, and happy days are here again. I'm curious how you look at the supply and think about those numbers.
Yeah, when I look at the numbers, you always have to separate yourself and understand, okay, well, what is crude quality? What type of crude is needed in the market? And when you look, when you talk about where the U.S. peaked, we got to that 13.1 million barrels a day. And did the world really need that kind of light, sweet crude? Was there really that kind of demand for that type of barrel? Or is there more demand for medium sweet that's coming out of Latin America, it's coming out of West Africa, it's coming out of parts of the Middle East? Or do they need heavy sour? Something that's also coming out of the Middle East, something that Russia has been able to put into the market. Some of the Latin American blends as well, and that's where you started to see the divide. All of a sudden, we really overshot the demand that was needed in the market for light sweet crude. and there was going to be a natural balancing act. Like, where does the U.S. fit in the global construct of the oil markets? And that's where you start to see these shifts. And that's when we look to OPEC, because what did OPEC do? OPEC really went after and made these cuts, but the type of blends in which they cut mattered most. And that's where, now that as we're starting to come out, Iraq saw an opportunity. It's like, well, if I claim ignorance and if I just continue to cheat, then, you know, I'll just say I'm sorry and I'll ask for forgiveness and we'll figure it out later. Now it's a dire situation. Now they need petrodollars. They need money. They need something to build up essentially their balance sheet to kind of keep everything stable. And that's where you're starting to see a lot of this cheating start to ramp up. And Iraq and Nigeria, you know, not surprisingly, the two weakest countries in terms of just balance sheets, struggles. Like, there was headlines today, Nigeria just got $1 billion loan. You know, they need money and they need US dollars. And the easiest way is to just keep that crude moving into the market, even ahead of where they're supposed to be. So that's why we've continued to see cheating. We'll continue to see cheating. And let's be fair, I think Saudi and the GCC, or the Gulf Cooperation Council, I think they understand the construct, and which is why they haven't reissued this huge drop in terms of, I'm going to punch those guys in the mouth because of what they've done. It's like, well, you can't, because then you have to give them money, or somebody has to give them some sort of stability, and they just don't have that. They've been paying Libya for how long to not produce. And that's where we're starting to see this growth. And now everyone likes to talk about U.S. decline curves. Well, we've seen a reactivation of spreads. We're starting to see that continue to creep higher.
Explain the reactivation of spreads to listeners.
Sure. So when you drill a well, you know, that's one thing. You're drilling the well, you have a rig there, you drill the hole, you set it up, and then the rig moves on. And now you have what's called a drilled but uncompleted well, or a DUC. Now you need a completion crew, which comes in and you know, that's what we call that fracking side, where you have the horsepower there, you have the equipment there, you have the sand, water, all these great things, and then you actually complete the well to then turn it on to production. So just because you have all these rigs running around doesn't mean you have an increase in production. You need the completion crew to come in and really connect you to the pipelines for that, to complete it so you can go to the pipeline. So as you see companies, like as we talked about decline curves, an E&P can't have a 25% decline curve going into 2021. Like the hill to climb becomes a mountain, and now the amount of money it takes, the amount of equipment it takes, the time it takes becomes so onerous that it's going to be a burn down, and that company is going to go bankrupt.
Yeah.
So you protect yourself. So you manage your portfolio. You do some workovers. You do some refracs. Workover being, you know, maybe cleaning it out, doing an acid wash, you know, doing something, or a refrac where it's something similar. It's just a little bit different in terms of time because it's a little bit shorter. And then you have new completions to kind of reinvigorate some of your decline curves.
And so we're seeing that because we'd seen the low in the frac spread was around 40. I can't remember the exact number.
Right, 45.
I think Matt and I had a bet that it was going to maybe hit 35. I think it hit 45. And then it's recovered. The last time I saw the frac spread number that Primary Vision puts out with you was around 70, 75.
85 was the most recent one.
Now.
Yep.
Okay.
Right,
so we continue to creep up from those levels. To your point, companies are looking at the Q4 activity saying, well, $40 oil might not be my favorite price. It's a heck of a lot better than 30. And I can't have such a decline in my production because that's going to create a whole bunch of other issues. So we're going to go complete our DUCs and do a little bit of, I've been surprised the rig count number crept up, but you know, we obviously got to start with the DUCs and then follow. So that's what we're actually seeing. Fair?
Yes. And again, like coming back to the initial conversation about, you know, getting to that growth, again, 85 to 90 crews is not going to give you production growth. It's just going to kind of keep you where you are. And we've gone from 13.1 to about, you know, anywhere from normalized for the hurricane 10.9 to 11.1. And the idea is let's just kind of hold in here, try to get us into 2021. So I I don't think you're going to see this huge decline curve show up in terms of the end of this year. That's something that could come out. But then as we go into 2021, you have Guyana growth, you have the GCC. Then, and when I say the GCC, I'm usually talking more about Saudi Arabia, Kuwait, and the UAE are really focused on how do I get more heavy crude? Is there some maybe subpar rock that makes sense? Because we do have a lot of refining capacity coming online, not just in the Middle East, but in Asia. And a lot of that has coking capacity. And not to get complicated, but coking capacity means you need a heavier slate of oil, which means that this oil that may have not have been made sense, all of a sudden on a spread level, on a premium level, you're going to actually do better than you would if it was light sweet. And that's when you start to see these weird shifts in the market, which are going to continue to materialize over the coming few years.
So let's talk. So oil. There's a lot of dynamics, and I think that's the important thing is that no one person realistically can get their hand around all of the geopolitics and the countries and the cheating and the petrodollars, and the U.S. is doing things because the companies are like, there's just so much going on. And oil sits at $40, but at the end of the day, oil needs to be refined, converted into something that we burn. And that's done primarily in the U.S. on the Gulf Coast. We talk about refinery utilization has really peaked at like 80, 81%. You have a short thesis on refiners generally, correct?
Yes.
And so let's talk about that, because I want to differentiate for listeners. Like, there's the market and what happens to oil prices and all the reasons that it drives. But then there's the underlying companies that leverage the price. So at $40, EMPs can or can't produce. But refiners are a really interesting one. Talk to me about how you see the refinery complex, that business model right now, and crack spreads and everything that drives that business that people might not understand as much.
All the fun stuff. Yeah. So
fun stuff.
The other thing when we talk about crude prices, you always have to consider the dollar conversion and the inflation fears and the dollar macro trade. And there's all those little fun things that can create some short-term moves that may be counterintuitive. But when you get to the refiner, it's very much a margin business. You're looking at this and you're trying to capture an arbitrage. And that's where we've hit a problem. And if you start with the demand side and we'll work backwards, what has been the biggest issue right now when people aren't driving, people work from home, nobody's flying, rails aren't moving, trucks are still driving, but shipping isn't going at the same level. All of a sudden you have a diesel problem. We already knew about the gasoline problem. Now you have a bigger diesel problem, which again, when we first spoke back in 2019, that was one of my bigger issues is like, look, diesel demand is getting soft. And that's a good indicator of what's the problem in the global market from a manufacturing side, from a just, what is happening in the underlying strength of the global economy. And we've continued to see that deteriorate specifically in Asia. So when you look at refiners in the U.S., you obviously have, the U.S. is the number one country in the world in terms of GDP and whatnot. So we consume a lot of refined products. But China said, well, the U.S. imports oil and exports product. I want to do that. And they started to build out to do that. So now you have a shift in the way all of this product is getting into the market, where gasoline and diesel that used to be an importing country is now starting to export. And that's shifting the chain. And all of a sudden you have all of these barrels showing up in Europe, in Latin America, in Africa. And the reason why I say that is when you look at the U.S. refining complex, we used to export a lot of this product out of the Gulf Coast. And now you're just seeing that slow down and you're seeing more of it getting pushed onshore. So Gulf of Mexico, you have the optionality. I can either go into the market or in the international market, or I can go, into pad one, which is the East Coast, or I can go to the Midwest, and then you start to flood north. So now you have a problem where demand is an issue, because you had the fall down from demand from COVID. You have these new exports that really haven't been there over the last, they've only really appeared in the last 3 years, 4 years. So, well, my margins are now getting hit, but you've had crude prices that we've talked about holding at this $40, this $41. So they can't sell product, and their lowest margin barrel, which we can say is WTI Cushing, is still holding in at 40, 41. So now all of a sudden you have a huge problem, because I can't buy cheaper oil and then try to make money on the demand side in terms of just the differentials in crude. And there's no crack spread because there's a huge glut in distillate and gasoline. And as you know, as you can just look at that flight radar app, you know that planes aren't flying and people aren't traveling. So there is a huge issue on the demand side. There's a problem on the differential crude side. So now you have refiners that are just burning capital trying to just stay alive, because there's an issue at the refining level where you need to maintain a certain level of throughput of oil before you have to just shut down completely. And
Well,
that's where we sit.
and I mean, it feels like Hurricane Laura. I mean, I don't want to call it a blessing in disguise, because natural disasters have big impacts on people's lives, and we can never understate that. But it led to some refineries being shut down, which arguably, like the COVID excuse, there are some that I think that they've chosen to leave down because of this that we've talked about, which is we need max utilization at some refineries, and it would just be easier to leave other ones down, and it was hard to make that decision. On top of that, because the Gulf of Mexico was shut in for roughly a week at about 1 million barrels a day, I was surprised that the market was like surprised that inventories in the US dropped this week, because it was like, well, if you have 1 million barrels a day shut in from the Gulf of Mexico, but demand stays the same the rest of the country, it stands to reason that 7 million barrels a day that usually would have come ashore is not coming ashore. Ergo, like, they should have had expectations that there would have been a draw. It's shocking to me. What is the trigger that for refineries makes people really see the weakness in there? I really thought it was going to be Q2 earnings. That didn't really happen. You know, we still see Valero trading at 53 as an example, HollyFrontier where they are. But what do you think? Is there a Q3 earnings in November catalyst that everyone just goes, oh my God?
You know, when you listen to some of their commentary, and some of them give some great color on the market, and others tend to kind of pitch this story that I think at times kind of glosses over the problems. They really talked about demand resurgence. They talked about growth in Q3. Things were getting better, and to be fair, for what they were seeing, you know, you just have to look at the gasoline demand data. Things did get better. They absolutely did get better. If we look at June, if we look into July, you did get a strong bounce off the bottom, which is something that we've been saying, is that we were going to get this huge bounce off the bottom, too much, too fast. You know, that move in March, if you look at March into April, you had lockdowns at peak. People were like, what is a COVID? Well, I don't even know what this is. I'm just going to stay home. I'm going to avoid everything and just lock myself in. Now that we're sitting there saying, oh, well, it's not that bad. We've learned a lot. We feel as though we have a decent handle on what's happening, and you had that bounce off the bottom. And so they pitched this story of demand recovery. Everything's back to normal. This is getting better. I'm actually seeing things getting even better than they were. And now you're getting the lack of fiscal stimulus. You're getting sticky unemployment. You're getting companies that said, wait, I don't need to fly my people all over the world, and I can still get a lot done. This is great. And so now I think the Q3 move is going to be, well, demand disappointed. And so that disappointed some of our expectations. And going into Q4, we're going to have to take some of these units down because there's just no demand. The problem is it's game theory. So it's a game of chicken. It's who's going to blink first. And China is sitting there saying, well, I mean, it's a state-owned refiner. So it's the PBOC's problem. It's the CCP's problem. I'm going to let them carry the bill, and I'm going to run at a loss because I'm told to. But then you have, well, what about South Korea? What about Japan, India, Europe? And just based on the complex, Europe tends to be the weakest hand, and just in terms of where their margin is and their outlets, just given where Europe sits on a little bit of a COVID resurgence, some issues, because, I mean, let's be fair, their economy hasn't exactly been stellar since the 2011 to 2013 slowdown. So the U.S. is sitting there, it's like, well, I don't want to cut because I can try to undercut Europe. I'll let them go down, and then that'll help my exports. And that game of chicken, I think, is coming to its conclusion, and you're going to see that pain not only in Q3, but then guidance into Q4.
Okay, so that's refiners, and before we go talk about the whole market, COVID, and some personal, because you're in a really interesting place. You're in the East Coast. You're in New York.
Yep.
You have family who's medical professionals. You have family who are police. You're at this juxtaposition of what's going on in society. So I want to come back to that, but before we do, let's talk E&Ps. The at $40 with current economics and where natural gas is at kind of $2.50, it's not as bad as it was, but it's not a great business model. Do you agree with that?
Yes, it's going to struggle.
Okay, so as all these E&P companies are thinking about their 2021 budgets, and they're thinking about their capital activity, which is really what drives 80% of their staff. From all the time that I was working, the staff, especially on the operations side, but the staff was there to help support capital activity. We're now going through the planning exercises at the end of August and into September, where they usually finalize a budget and present it to the board in October. And then depending on the year and what's going on, they announce what their 2021 plans are. What do you think companies are going to do in 2021? And I've said for a while, I'm short E&Ps for all the reasons that we talk about. But do you think that we've even seen remotely close to the pain in the U.S. sector for equities in E&Ps, or are we near the bottom? And how does this work with the overall market?
I don't think we're near a bottom, just because I think we need to see additional consolidation. You need to see guys getting some economies of scale, and just the debt levels are going to continue to be onerous for a significant amount of them. So it's either going to be, I'm going to go into a restructuring, so I'm going to have to file bankruptcy with a pre-planned package, come out at the other side stronger, sell myself in terms of a take under, if you want to consider what that means. And a take under is essentially, it's for equal equity value. And it's because there's so much debt. The acquiring company is like, look, your equity has no value at this point. Like, the debt is too onerous. And you're starting to see some of these components, because it's really hard to, at this point, sell acreage stakes, because selling acreage stakes is just, you just might as well sell the company and try to get some economies of scale. Now, I've had a lot of commentary with clients and others that when we do a lot of consulting of, well, why are people still operating? Like, why even operate in this market? And it was interesting, because when we really got low to that 45 level, and really, like, as we talked about, maybe going to that 40, 35 completion crew activation, refiners started to panic. They're like, well, I still need oil to operate. So then you have a situation where your end user will pay you a premium just to stay operational, because they have to stay operational. And then you saw, well, the midstream guys are like, well, I need the oil. Like, there's MVCs, or minimum volume commitments, that you have to meet. Let's come up with a deal to see if we can make things work. So that comes to the long way of saying your hedge book will matter, your end user will matter, and the end user could either be a refiner and or the coast, because as much as we want to say the U.S. oil is a problem, there's still demand out there for light sweet crude, and we can't discount that. Whether it's 3.5 or 2.5 is kind of where we're going to see that delta, but it's within that range that people are going to want this oil. So can I get to the coast? Can I fill a boat to get to my end user that may be in Europe or Asia? And those are the kind of things that are going to have to happen, but it's going to be just economies of scale. Like, I'm going to manage my pipe. I'm going to manage my completion crews, and I'm going to leverage just my sheer size to increase that volume to spread that cost out.
If you were to make a guess, and then we'll talk about the overall market. If you were to say December 31st, what is oil price and what is gas price, natural gas price? What do you think? What would you go with?
So I think we close out with a WTI Cushing, I'm going to say at about 35, 37. I think we have a little crack here, and then we start to climb back up to that level. I think Brent is going to kind of remain that a little bit of a premium there, and it'll hold above 40. I think that spread can widen. And that's just in terms of where we sit in the market. And gas, you know, I can play both sides of the gas coin. I'm going to take the cheap way out and just say that we close here, because I think there's the one thing that's been nice to see. Production's come down, but demand has been relatively flat. And we look at that when we look at burns, when we look at residential consumption has increased. Even as we've lost commercial real estate and people not going to the office, people have been burning more at home. We already had the residential complex shifting to natural gas away from heating oil, again, coming back down to a longer term headwind when we look at refiners in terms of total diesel consumption. But natural gas continues to take that market share. The bigger conundrum is going to be LNG. I mean, how much do we have cold winters? Do we get an increase in LNG demand? Because right now, if you look to a lot of deferred cargoes that were kicked out in February, March, April, going into Asia, will that be a cap? And I think there's enough kind of back and forth where we just kind of sit here at this 250 level.
Yeah, I can get my head around that. Okay, so the market has gone up and to the right, and you and I talked when the S&P was there was a little correction in July, I want to say, and I think that S&P had kind of run up to like 31 or 32. It pulled back to maybe 29.50, and we talked, and you're like, I mean, I talked to my friend, there's just nobody who's short. There's a whole bunch of liquidity. The Fed is acting crazy. We had Danielle DeMartino Booth on the podcast 2 weeks ago, and she was very similar. Like what the hell is going on? It's up and to the right. And you're like, dude, the S&P is going to 3,500. There's nothing you can do. It is a freight train. Get the hell out of the way. We saw a crack yesterday where the market fell 3.5–4%. It wanted to rally a bit this morning, and when I last looked, it was down about 1.5%. We've started hearing more commentary about pullback. I think there's a lot of question in the numbers and what the real thing is. What's your take on it, and what are you hearing in New York with all of your money manager friends and hedge fund friends, and how are they positioning for this, and how are they not absolutely terrified when Zoom, in the best quarter they ever possibly could have had, with a government mandated shutdown and companies trying to figure out what to do, went to the only app they'd ever even heard of? They had 92 cents a quarter or share earnings for the quarter, which annualized is like $4 loosely, and they traded up 41% to $450, which would be more than 100 times forward earnings on the best imaginable quarter in the history of the universe. Right. What say you?
So we as you've seen with our shows, like we look at data on a regular basis, but the problem is what data matters. And that's where we were looking at this when we had this conversation of, look, the market's going up and there's nothing you can do to fight it. It was because bad news was completely shaken off. The VIX was falling. The put call ratio was falling. People all of a sudden had this exuberance. And when you think about that forward look, when the market pulled back to 2,900 or 2,950 or so, there was a nice consolidation, and the data started to get a little bit better. Now, was it stellar? No. Does it support where we went? Absolutely not. But you had this shift where things came off the bottom. They came off the bottom harder than I think people were expecting, based on the kind of that doldrum where everyone was depressed sitting at home. And you got this over exuberance, but it wasn't stock purchases. It was leverage to the upside. You had a ton of calls being bought. You had this VIX, even though things were getting better, you had the Fed coming in aggressively. You had people taking this capital, leveraging it. So no one wanted to buy stocks anymore. People were like, wait, I can buy an at-the-money call and triple my money. Why would I ever buy a stock? And all of a sudden you get these big leverage plays, and then they worked, and they rolled them again, and they did it again, and they did it again. And the problem was when, the stocks that we look at in the world we come from, there's clear supply demand. Like, I can look at that tank. I know how much oil's in it, how much gasoline's in it. I know I can look at the market and say, oh, it's trading, in this country, in this region of that country for this price. And I know what the margin is. What is the Zoom algorithm worth? What is the Zoom, what is, and I think that's where you all of a sudden have this tech mantra of, well, tech is the new reality. Tech is going to be the view. And when you talk about 100-time earnings, you have to think it's like, well, they're going to grow into that. They're going to see that shift. Some of those sales are going to be pulled forward. Things will look a lot better. The cash flow is going to be there. And it was almost like people were convincing themselves that tech's the place to be and forward earnings don't matter because this is where the future is. And we saw this in the tech bubble in the past. We've seen this in bubbles previously where people wanted to mold data points into their narrative instead of looking at the data and letting the data kind of dictate what the narrative is and where valuation should be. So now what happened? And this is something where we look at the data and we saw the data plateau. We saw things getting struggle on activity level, mobility levels, manufacturing levels, but the VIX was falling and things still look pretty good. Then what happened? The put call ratio hit an all-time low. And this is like, okay, well, now that the greed level has gotten too high and the VIXs started to creep higher, people were starting to get a little concerned. And then that's where you saw that crack, where all of a sudden people lost money, where it's like, oh, I'm going to buy at the money call, and I'm going to make a ton of money. Well, you just lost 90% of your value. And that's the fear.
And so do you think that this crack two things. Number one, does a crack in the market, and Mohammed El-Aran, who's the chief economist or economic advisor to Alliance, and he's always on television, said, I wouldn't be surprised if we see a 10% pullback. On the other side, the Fed had been buying things like Apple bonds, which, you look at Apple's stock price. If Apple needs money, they could go raise money by issuing stock. They don't need the Fed purchasing Apple bonds. It makes absolutely zero sense. Do you think that with the Fed's action, if the market pulls back 10%, does that either break the deadlock in Washington on a stimulus package? Does it make the Fed mobilize to put even more liquidity in? Or are we now at a point where, look, we need to let price discovery actually happen, and we need to have some level of normalcy because we can't go up and to the right to an S&P 5,000 for no reason, because all we're doing is we're setting ourselves up for a tulip crash in the Netherlands of 1300.
So the Fed is really tapped out in terms of what they can do based on what they've outlined. They've done their ETF purchases when you look at the bond ETFs, which is where you're starting to see a lot of these investment grade bonds come out. Because I think there's a statistic where if the Apple's cash if Cash Hoard was spun off into its own company, it'd be like the 7th largest company in the world, something absurd in terms of just sheer size of cash on the balance sheet. So like you said, they do not need support. But when you look at what the Fed has done, and this is where I am a known Federal Reserve hater, central bank hater in terms of what they've done to the market overall. But they were trying to essentially step in and replace fiscal. They were like, look, we're going to have to do too much, or we're going to have to do more in order to offset the inaction in Congress or Parliament, because let's be fair, this is a global problem, not just a U.S. problem. And their next play could be, look, we're just going to straight up buy equities. We're going to buy the S&P, the S&P futures or the S&P ETF. We're going to buy IWM, the Russell. Like they can do something like that, which then would create this skew that would be just ungodly, which you really don't want to see. I think, to your point, it's going to respond. It's going to create a fiscal response, and I think the fiscal response is, both sides have kind of dug in, and I think they're waiting for the election because they don't want to give too much and give away too much. In terms of the Republicans don't want to give away $2 trillion and then have the fiscal conservatives, the 7 of them that are left, come out and say, look, what are you doing? Like, you can't give more bailouts. And then at the same time, you don't want the Democrats to appear weak and say, oh, well, we're caving to the Republicans. So I think this is going to create an opportunity for both sides to come to the table again and give some stopgap measure ahead of the election. The bigger issue now that we're starting to see, and this is coming to my original world where I come from of FX rates and commodities. Rates are becoming a little bit more of a problem, and it's a duration question. You're starting to see the 20-year and 30-year. They've come in pretty soft. Some of those recent issues, and when I say soft, I'm talking relative, because let's be fair, we're in a new era of lending. So, but when you look at it, the bid to cover was weak. You started to see some of that creep, and that was when the conversation about inflation started to come in. And have we actually saturated the market in terms of what it can tolerate? The Fed has come in and said, no problem, we'll just buy the difference. And now China's come in and said, we're actually going to cut some of our treasury holdings, and we're going to.
Yeah, they said they would drop as much as 20% of their U.S. dollar. I mean, that is like, quietly, that is a huge piece of news that just nobody pays any attention to. China, one of the biggest buyers of our currency, is going to drop 20% of its position.
Yes. And that is an issue for not only future consumption of treasuries, but I think it also admits a problem within China. Because what is China trying to do? They're trying to pull forward dollars. So why are you trying to pull forward dollars? Do you have a dollar shortage? And if you look at the banks there, just like our banks, in terms of bad debt expense increasing, in terms of balance sheet stress, and just based on poor performing loans, you have a very similar issue, if not worse, given the fact that we know things are a problem. So if they're publicly saying things are a problem, we know behind the scenes they're way worse. So I think you're seeing an issue on both sides of, oh man, the U.S. is going to struggle placing this debt. And then on the other side, it's, well, why is China so concerned about dollar consumption? And I think that this is why you're starting to see a fear in the market of, can we really continue to stimulate to maintain these levels, waiting for the real economy to catch up? And that's why, when we've talked about in the past, is gravity is real. And I will always bet on gravity. You can have some exuberance, you can have the things coming in and inflating the market, but gravity always wins. And that's what I think you're starting to see now.
Yeah, and I mean, I say it in my posts, and people think I'm being snarky about it, but I sort of, once upon a time, there was an oil and gas industry that traded at 7 to 10 times cash flow because you were in the Permian. And then people realized that it's actually about net asset value. It's not about some random multiple. And I think we see that in Zoom. Probably the poster child of exuberance. We're going to talk about your favorite company in the entire universe, Tesla. Oh, now, and my favorite bull argument of Tesla is that it's a bet on Elon's brain. Now, that's a $375 billion company which trades at north of 15 times revenue, makes less cars than Toyota, like 5% of the cars of Toyota. And people's bull argument on Tesla is Elon is very smart and he will solve the world's problems. Therefore, we will give them this bid that is beyond sensical. And on top of that, they did a 5-for-1 stock split to somehow make it more palatable for retail investors. I'm not totally sure. Talk to me about what is going on with Tesla as a indicator of the rest of the market.
So Tesla to me is really, as the way Tesla stock trades, so will the market, because I think that is the definition of a bubble stock, where everyone's trying to, again, bend their narrative into Tesla. It's like, oh, well, it's not a car company, it's a tech company, or it's not a hard asset company, it's a software company, and they're creating software and they're doing this. It's like, okay, well, where is money being generated? And when you look at Tesla, people forget that there's multiple businesses underneath that umbrella, and you have to break out the businesses. So you have Tesla, the car company, you have Solar City, the solar company, you have SpaceX, the space company, and you have the boring company. Now, how many of them have we heard about? How many of them have actually made money? How many of them are actually viable? So you look at SpaceX. SpaceX has done some great things. It's operated by a woman, and it's gonna embarrass me because I don't remember her name. She's fantastic. She is a visionary. She has taken many things and just run with that company and has achieved really, let's be fair, things that were inconceivable even 5 years ago. But when you look at the total backdrop, and when I look at the total backdrop, I look at Tesla and I look at Solar City. So let's take Tesla for a moment. People don't just sit back and say, well, it's Tesla's market, so we're just going to let them have it. And that's not how this works. Now you have a situation where you have real car companies getting behind this and aggressively attacking the situation. You have, can Tesla really stay ahead of battery technology? Can they really stay ahead of engineering? Can they really stay ahead of, the consumer and the consumer demands? And if you look at just people, and this is just looking across the issues in terms of getting your car fixed, getting your car delivered, getting your car situated the way you want it has been a huge problem. Well, Ford has a dealership network. Toyota has a dealership network. BMW has a dealership network. So these are things that they have a built-in infrastructure that is going to enable them to step in and say, look, no, we actually have the same battery, or we have something similar or something along those lines. And let's be fair, software is software, and you have a lot of competition coming into the market. So that is a problem in terms of just overall US, European demand. And now people turn to China. And it's like, oh, well, he's in China. It's like, yes, well, what do we know about China? China steals IP. China steals. So I always joke that there's going to be a Tesla, factory across the street from the Tesla factory in the matter of 5 years, and all of a sudden it's going to sell at a $15,000 discount to where Tesla sells their cars. And I just think that when you then shift to solar and you start to shift to, well, they have the power wall, this is going to be great. Well, how effective has the solar been? Have they made any advancements? Because from what I've seen, I worked in the solar industry through 2010, 2011. There hasn't been much advancements in terms of actual capture of energy, but the battery is interesting. What is the battery doing? But the battery is going to have limitations. How fast can it charge? How fast can it discharge? There's a thing called a electromagnetic field for a reason. You have to keep that small. So are we going to cover it in lead to make sure that it doesn't give people cancer? Are we going to bring back the lead trade? There are so many things that come down to it. And then one of the shows that we recently put out was on rare earths, because not only is there an issue in terms of, okay, well, what about the demand? What about the supply chain? Where are the rare earths coming from? Where are the raw materials originating from? And can that be competitive? Like, as you said, in terms of car sales, prices are going to go up. As these other companies get into it, nickel, lithium, magnets, all of these things are going to get more expensive, and it's going to be very difficult to compete if you're only selling 25,000 cars.
So I believe the COO's name is Gwen Shotwell. Is that right?
Yes.
SpaceX lady.
Yes.
Yeah.
I thank you.
No, I had the advantage. I got to look it up while you were talking.
Okay.
So, but yeah, I mean, and so Tesla, and it's interesting because you put all these out, and there are a lot of people who are short Tesla and have got absolutely crushed in this run up from ultimately 300 to 2,000. All the challenges remain, and yet people aren't trading on fundamentals. And that you said, I will take the bet on gravity every time. And at some point, something has to trigger. When I looked at their Q2 earnings, I think that they had north of $500 million of revenue from tax credits that they sold. Yep. And so it's like you've created this weird carbon market that a big portion of their profitability is from selling these credits that presumably, I mean, it's absolutely bizarre to me, and yet here we are. What do you think the S&P ends the year at if you were to have a bet?
Oh, wow. So my bet would be that we, faring even after the election, I would say that we close just south of 3,000.
Okay, that's which, to be honest, it's so very funny because when you and I talked in April and May, I mean, you were talking about S&P 1600. Now, I think that realistically, had price discovery happened, and I think we were talking about Delta at the time, and you're like, well, if I could buy Delta Airlines at $10, and it was 20, I would do that. But then they had the bailout, and then they had the bailout, and then they had the stimulus, and then they had the 500 billion Fed liquidity. Then they had the buying. And so the market was just totally distorted. It rallies up to 3,500. It's kind of funny that at the time 2,900 would have seemed so obscenely high relative to the underlying economy but now if we were back to 2,900, I'd be like, well, at least this makes more sense. And it shows you how relative value is such a thing. Because we're at 3,500 now, 2,900 seems better. But realistically, when you look at Main Street and jobs, and I don't even think we've seen the real job losses, we're 2,500, 2,400, 2,300 would be more reasonable given where we are in the economic cycle.
And when you look at things like that, and this actually factors back into Tesla, when you look at municipalities, you look at governments on a federal, state level, they're going to struggle just based on they're losing tax revenue, they're losing, they have to pay out unemployment. You're looking at stress across the balance sheet. And if we had a storm come through that ended up being a windstorm, and some people didn't have power for 10 days. You look at California's facing rolling brownouts. So now you have a situation where if we really want to see EV and some of these things take off, we're going to need a significant spend in infrastructure. We're going to need to see that move into really energy infrastructure as well. And how do you do that when you have municipalities and governments in general struggling under this weight of, I already have so much debt because I did nothing to shrink my balance sheet over 128 months of pure growth, if you want to call it that, from peak to trough, from trough to peak. I'm sorry. And now you have a situation where it's like, well, I want this. My constituents want this, but I don't have the money to deliver it. I don't have redundancy in my system to actually deliver what's being asked of me. And that's, I think, a bigger issue. And when we talk about what can the government do, what should be done, it's really a focus on infrastructure.
So I want to build off that for our last topic, which is the state governments, the balance sheet of feds, the tax revenue, the COVID response. You're in a very unique place, and also, I mean, the defund the police, the divisiveness that exists now in society as we head into the election. Mm-hmm. How do you think about where we go? And you gave an example of COVID in terms of like, so you want to send your kid to school, but your kid has a cough or a temperature, so you have to, do I tell the school? If I tell the school, the whole family has to quarantine. My employer might not give me the 2 weeks off to quarantine, so I'm not going to tell anyone. Therefore, I'm like, there's so much complexity in the response now that kids are going back to school and parents need to get back to work because they're running low on savings. Where are we, and what happens with all of that with COVID in particular?
I when we first started talking about COVID, my whole thing was testing. We need the ability to test, and we need to be able to test quickly and often. And that's the only way to kind of stay ahead of this. And my oldest daughter is going back to school, and if she has a fever, if she has a sniffle, she needs a negative COVID test prior to going back to school. And if you think about it, if that happens on a Tuesday, it's essentially she's not going to school that week. So now you have a situation where if she's not going to school that week, she now has to stay home, and she's going to be on Zoom. She's going to be on some sort of remote learning until we have the proof, and then she goes back.
And she's young, right?
Yeah, she's going to be 5.
Which really means you or your wife or a grandmother have to be there because like they're not able to function with Zoom. So it's all well and good that they can color the penguin purple and write P 7 times, but if they have to upload this piece of work presumably to the teacher, and that can't be done without a parent because after all, the child is 5.
Exactly. Like, ask a child to use a keyboard, and when they just learned how to spell their first and last name and maybe 10 other words. So there is a huge amount of components that come into it, and that's where we've asked the school to put her with 3 of her friends. We're friends with the parents, and then if we go remote, on a permanent level, there will be a little pod, and we would be able to share some of the responsibility across all of the families. And let's be honest, like when we talk about and this gets into defund the police and some of these other things, when you start looking down the social curve, some people don't have do you have a computer? Do you have internet access? If you do, is it spotty or is it good? Do you have the ability to take off from an hourly work? Because people who are salaried may have the opportunity to say, well, I'm going to take a day off. I'm going to take vacation days. People who are hourly do not have that luxury. They do not have that ability. So then that comes down to the social construct again. And the reason why it comes to an issue of, well, what happens if we go remote full time again? Do you have the infrastructure to carry that? Because we saw that as a huge issue in the beginning of this year, where you had families that, well, do you go to the library? Do you set up safe zones for these kids that, maybe relied on school for food and just a place to go as in terms of daycare? And those are going to be issues that really become more of a social problem than it is just like a one-off family problem.
Now, you talked about testing, and it's really interesting to watch as we have 6 months now where the narrative and the narrative, and I gave you credit in March because you were the first person that really described what the flatten the curve was, because your mom was at the hospital where they took 22 floors of a building that was all COVID patients before anyone knew what was going on, and it was about ventilators. I think we've subsequently seen, as we've learned more, that 88% of people on a ventilator ultimately end up dying, right. That the ventilator is a big scary thing, but that there are things before that are important. Mm-hmm. And you talk about the importance of testing. You don't really hear a lot about testing. Like, you hear a lot about vaccines, but we don't have a rapid saliva test that within 2 hours or something you could know that makes it even usable. Because if I can't get a test back for 4 or 5 days, that's actually basically useless, because if I'm not showing symptoms and I just want to know, the thing might only last 2 or 3 days. And then by the time I get my test back, and then what's the accuracy of the test? Because you hear a lot of false positives, a lot of false negatives. Like, so where is the US and just globally, where is medicine on testing? And are we going to see any change to that in 2021?
I think we will, and we've already seen some new testing regimens come out that have sped up that process to try to get a bit more reliability, but also speed. The problem then comes down to, well, who pays for it? If you have someone who may have a poor insurance carrier, or someone who has that let's call it the coverage just to say you have insurance but really does nothing, that's going to be a problem, because you're talking about, let's call it $150 every single time. And just based on what the regiment looks like with my daughter, and I'm assuming other people, I mean, let's be honest, like, you have kids. I mean, kids at that age are petri dishes.
They're sick all the time. I mean they're
10,
runny
20
nose.
times. Right. 10,
minimum.
It's
minimum.
just, it's so how many tests is that? How many times, think of 10 tests times $100. That's a lot of money for a lot of people. And that becomes its own issue in terms of, well, who covers that testing? And
also for kids, because so few have died,
right,
unless there are comorbidities. You're like, I mean, kids get sick, and quite frankly, there is an argument that the immune system, like, it needs to learn and build. And unlike the flu, which does kill kids, COVID doesn't. So then for families who don't want to spend $1,000 on 10 tests, they're looking at their kid being like, well, you're fine. I'm not even going to have you tested.
Right. And that becomes the problem. And where that would be the wrong response, because you want to make sure, because again, that child may not get infected or may not be in, but when they give a hug to grandma, well, that's then a problem. But if you don't have the money to test that child, well, then you could just see the same type of resurgence. Now, the things that you mentioned before in terms of death, like, we've just seen that naturally come down, because we do learn, science is active, and you see that turnaround. The turnaround is, what did we learn? Don't go on a ventilator, go on CPAP. Don't force fluids, actually dehydrate them to pull fluid away from the lungs, give them steroids and give them an anticoagulant, because all of a sudden those last two things, the steroids and anticoagulants, open up the lungs. They keep things fresh. So now you have a turnaround where you've not only decreased the morbidity rate significantly, you've also decreased the time in the hospital. So those are things where you're not stressing the infrastructure to the same level. So you're saving money there. So you might as well take some of that capital and put it towards testing and create. Look, guys, if you don't have insurance, you go here and you get tested, and you will know within 48 hours at a minimum, at a maximum, if you do or do not have COVID. That is what should happen. Will that happen? Well, we saw the response from, and this isn't just a US thing. We saw the response to COVID globally get just bumbled left and right. So I do not expect that to happen, even though that would be the most accurate way to not only keep this from spreading and getting big again, but also making people feel comfortable and confident that we're doing the right thing. And let's be honest, what does confidence do? Confidence increases spending. It increases your willingness to go to the restaurant. It increases your confidence of flying in a plane, of doing things that are normal. And without that, you're just going to take the easy answer, which is, I'm going to stay home.
Well, and it really begs an interesting question with football season coming up. The sports, they've restarted in a way, sort of in the bubble. But when you think about, and I was doing the math, and I was actually shocked because I didn't realize how much ticket revenue actually mattered. Because I always said, well, it's all about broadcasting, and maybe for football and some of these other sports. But like, I was looking at hockey, and I said, let's say there's an average of 15,000 fans that pay $100 for the ticket, and let's say that the food services are offset by the cost of running the arena and the rent and all that stuff. So 15,000 times 100, $1.5 million a game, 80 games. Maybe 40 home games for the team, but that's $60 million times 30 teams. That's $1.8 billion to a league based on tickets. And so, it's all well and good for everyone to say, well, this was a short-term thing. And I had Vicky Hollub on the podcast, and we were talking about work from home. And she said, for 6-8 months, this was good. But we need people in hallways collaborating. We need people working on projects together. We need people not focusing on their kids. She didn't say this. I'm paraphrasing. Yeah. We need people not focusing on their kids at home while they're doing Zoom. We need them actually doing their job, because that's what we pay them for. Otherwise, we have to cut their salary. But so the NHL and the NBA and all these leagues, they're starting without fans, but revenue from the fans is a big deal. And if I can't go to a game and watch my team try and win the Stanley Cup and score and go through the emotional drama of 20,000 of my closest strangers like cheering and chanting, which brings us back to testing. If you have 19,999 who get tested every day and one who can't afford it for whatever reason and spent their test money to go to a game, and they happen to be sick, then they infect the 5 who just had a test, who then infect the 5. And so we never, ever move away from viruses, which is why flus and colds and sniffles and everything, they just circulate in society because you can't eradicate them. When does society just say, you know what? We just can't do anything about it. We just got to let it. It is what it is. Caveat emptor, do your thing. What is that even a possibility, or does that have too much egg on the face of politicians, or what happens?
That takes time, and the time is like, if you look at the 1918, when you look at the Spanish flu and you look at what the flu did, that happened to be a strain that was very strong, created chaos in terms of just death and uncertainty, and then it went away. And it didn't go away because the flu disappeared. It went away because, just like anything else in our beautiful world, it evolves, it changes. If you kill the host, that specific strain ends up dying off. So when you look at just what's going to propagate the most, it's going to be the one that is more more contagious, but less deadly. And that is as you see that kind of work through its way through society. And then that, I think, would then, it's like, oh, well, we haven't really seen a big spike. We haven't seen someone get really sick. I don't know someone who's died anymore. I don't know someone who was home sick for 3.5 weeks and still doesn't feel well. Those type of stories and anecdotes then move through the system, and then people feel better, and then you start to get back to normalcy. The problem is, what was the weight ahead of COVID? And the weight ahead of COVID was, we were already struggling. We already had central banks that had been trying to stimulate the economy essentially since 2009, on and off, depending on which country you're in. and now we're suffering under the weight of that, where we never were allowed to have a correction. This became the black swan event that forced a correction. And then we tried to overcompensate by looking at the law of diminishing returns, and we're just going to plow the market with additional liquidity because we've been doing it for 10 years, so we need triple the amount. Those things are going to weigh on and people will blame COVID, but let's be fair, like, it's really not the issue it was in previous years, previous months, and that's going to take time to get people back into their normal action.
So, yeah, we are in a very interesting world. Last question. So, New York City. We hear a lot about defund the police. You know, it's clearly not Portland, but you know, the NYPD is you know, all the shows about it, and they're like this megalith, you know, organization that people all have views on because it was the biggest city. There were crime waves in the late 70s and 80s when I was born there, and then so the city kind of cleaned up, and you know, they wouldn't allow graffiti, and they went through a big anti-crime safety, bring people in, and New York was like the place to be. And now we've seen a change. What are you seeing in New York? What are you seeing with people actually leaving? What happens to cities? And I, you know, you have I think a really good front row seat for that in America's largest city.
You know, the urban, the shift, everything went from you have to get out of the rural side, the suburban, you have to be in the urban setting. That's where it's happening. That's where things are going. And you had this consolidation into the urban construct. And now you're starting to see that break down, and you're starting to see people say, well, I need more suburban space. I need more of a rural space. And the work from home ability has increased, because before, even though you could work from home, there was a stigma against it. You know, you couldn't really do it. You know, maybe if you did it, you know, you were looked down upon. So now we saw that it worked. It doesn't work as perfectly as everything else, because that, you know, if you ask anyone who's done this, instead of working 8 hours, you're working 12 hours because you're being distracted by your kid, or you have to go make lunch or something that you didn't have to do in the past. But there is the ability to have more of a balanced lifestyle of maybe 3 days in the office, 2 days at home. And that is allowing people to leave. The problem now is really that safety side. And it was interesting because my wife and I just watched, it was on PBS. It was one of the specials on the 1977 New York City blackout. And when you
That was the year I was born. My mother was pregnant, and she tells the story. She was, I believe, stuck on an elevator for a number of hours with my pseudo uncle, and yeah, and it was hot as all get out, because it was like right about now. I'm coming up on my birthday, and I remember it well because my parents tell the story all the time.
Well, that was what broke the system. You had it was a heat wave, so you had everybody with their ACs on, and then you had a lightning storm that took out something, and then it overdid the whole system. The first, and the special goes through the first 10 hours. Everybody was partying, you know, get rid of the food. Everyone was eating in the streets. Everything was calm. And then there was a turn, and the turn was, all of a sudden people say, wait, there are no cops around. Oh, I want that. And I haven't been able to have it because, you know, we were already seeing some of those social stresses in New York City at that time. And then the looting started. And then you all of a sudden had, you know, these massive fires happen. And there were people that were being interviewed, and they said, you know, that street that was looted and burnt stayed like that for 15 years because people didn't feel comfortable coming back. People didn't have the money to come back, because then you go into a slowdown. And that was when everyone talks about, you know, the graffiti and the disgustingness of New York City from the 70s well into the 80s. And then you had that cycle. Cities are cycles, just like anything else. You know, it'll get really bad, it'll come back. It always does. The difference is now, what are the jobs going to be? And this is why when I look at New York City was built on finance. I mean, finance was its hub. This was the financial center of the world. The financial industry has been shrinking since 2008. There has only been firings. There's only been layoffs. There's been companies moving credit card services to Delaware, to Ohio, other areas that are cheaper. Operations moving to Maryland, moving to to not only the Mid Atlantic but the Midwest. These are cost centers that are now gone. So, and let's be fair, with Zoom, with all of these other things, I can now do business. I can fly to London from O'Hare or from Atlanta. I don't need JFK. So, and I can do this. I can be on Zoom and we can have a great conversation. And I don't need to be in New York City where I'm going to see you every other week. And those are issues that are going to have to change. And there's going to have to be a reinvigoration. And the question is going to be, what steps in? Does New York City become a tech hub? Because it has the infrastructure. I mean, who has the subways and the connectivity that New York City has? So it'll always entice people, but there's going to be a safety issue. And this comes full circle to that defund the police and what is happening in the market right now. It is less about defund the police. It's more about social mobility. People feel disenfranchised because of the weight that has been put on companies, where you have all these zombie companies, you have all of these, placated individuals, where instead of investing in my business, I'm going to issue debt, buy back my stock, and hey, look, I made a profit, but it was a paper profit. You didn't build anything. And that really hindered what the abilities were. And you've seen a stymie in terms of that corporate ladder. So then people are sitting there and it's like, I'm busting my ass and I'm still making $80,000. Why haven't I increased to $150,000? Well, they aren't getting the ability to operate their own P&L. They don't own the company. Like when I talk to people in my own family and aunts and uncles of friends, they talk about when they worked at GE, Lockheed Martin, by the age of 28, they had P&L responsibility. They had something where they could literally claim, this is my company. I own this company. Who feels as though they own the company they work for? Who feels as though they owe them something? And that's why you've seen that with job transitions. How many, in the 80s and 90s, you maybe had 3 or 4 jobs in your career. Now you have 3 or 4 jobs in the first 7 years of your working career. And you have this shift. And that's why when you look at, again, redirecting, so do we have to defund the police? Absolutely not. Do we need different training exercises? Absolutely, because things are getting different, but at the same time, there's also been a loss of respect for police. There's been a loss of respect where people are projecting. It's really not like, look at the New York City, the NYPD, my uncle, who was a detective lieutenant, he said, look, the police force reflects the community. He was like, if you have a cop who is angry, who's aggressive, who looks down on you, well, what does the community look like? What is happening in that community? I've always had positive interactions with the New York police, and people may say because that's my skin color or whatnot, but I've seen I've seen the both sides of the equation in terms of the aggressiveness on some of the cops. Like when you look at what happened in Minnesota, was that wrong? Yes. Should he be in jail? Yes. Was that murder? Yes. I mean, we saw the videos, but that doesn't mean some guy standing on the corner of 42nd and 6th did that. He's just wearing the color of the blue, and he's there to help protect you. He doesn't know that guy. He didn't train with that guy, so that you can't reflect that. But we're seeing that the existential problem of, I feel disenfranchised because I was told if I came here, I would be able to bust my ass and succeed. Well, I know a lot of people that have been doing that for 10 years and really haven't achieved what they feel they should have because of the lack of social mobility. And that's what you're seeing. And that's what you saw in the 70s. And that's what you're seeing again. People feel disenfranchised, and it's a job problem.
I agree, and I do think that gets forgotten. And people have been locked in their homes. People are dwindling their savings. People have been disenfranchised by society. And you can call it whatever you want. You can call it racism, but I do think that there's actually it's more about wealth, and that if you are a wealthy individual, you can hire a lawyer. Therefore, when a police officer maybe acts in a way that would generally in one way lead to a shouting match. You're like, no, you can take me down. I look forward to my lawyer getting involved and suing you. Not that that's like the right answer, but you feel like you have this social safety net, which is really a wealth thing, which, as you said, is an upward social mobility thing. And when the American dream collapses and people don't have the opportunity to be free and achieve results, it manifests in this.
And it's also an education thing, because what did I learn from my uncles that were cops? I learned that don't say anything, listen to what they're saying, get their badge number, and there's protocol of reporting that badge number. Like, there are things where people don't realize or don't appreciate that there is an internal affairs system. There is a reporting system. There is a way to sanction that individual cop. And that is what is, I think, lost in terms of there is an educational side in terms of we have to let those systems work. There are laws which, if we want to get back into Tesla, there are laws when we talk about guns, when we talk about finance, when we talk about all of these different companies and entities. There are clear laws at the SEC, at the federal, at the state level. Just enforce the laws. Like, we need to enforce the laws that we have and hold to them, because they're there for a reason. They've been created because we saw these issues. I mean, we look at the riots in the streets. They're not new. I mean, we can go back 2,000 years, 3,000 years. There's been riots in the streets over social injustice for thousands of years, and there will be continuously. We're not that smart. We are animals that tend to have history repeat on itself, or at least rhyme, because we don't learn from mistakes. And what are we doing right now? We're seeing the same mistakes. And we have two sides that are highly polarized that don't want to come into the middle. And that's where it's like, well, should we defund the police? Well, maybe not, but we should definitely talk about what training looks like. You look at Black Lives Matter. It's like, do they have a foot to stand on? Absolutely. There is a serious problem that needs to be addressed. But do you achieve that by getting rid of the nuclear family? No. We know from statistics, the nuclear family, the stability of the family is paramount for creating a very safe environment for children. And there's a conversation to be had. Well, how do you create a nuclear family? How do you support a nuclear family? Is it a job problem? Is it a job training problem? Should we not only be providing housing, but significant job training? Is there something there? And then should we have the police that are coming out and saying, well, I have to be more respectful for what's going on? Because when you look at some of the recent data points, over 80% of people in these stressed out communities don't want to lose their police. They do feel better with the police there. It's just a matter of how do the police interact with those, and do they need to respect the fact that many people do want them there, and they need to respect the fact that these are individuals that want them, and they need to respect them, and they need to be respected. And there's, again, it's a respect game, and it's a trust game, and the trust was lost, but it can always be found again. And it comes from conversation. It comes from meeting in the middle. It comes from creating an environment in which we can discuss. And you and I have talked about this in the past. When you sit behind an anonymous screen with a Twitter handle or some, Instagram, whatever, you can hide and you can throw stones. And we've lost the ability to debate. We've lost the ability to sit and actually have a conversation. I mean, we just watched Hamilton on Disney Plus, and they debated. They hated each other, but they debated, and it still resulted in him being killed in a duel. I mean, he was shot by another man. But so it's not like this is new. It's just we need to have the stability and the open-mindedness to sit across from each other at a table and actually stare each other in the face and debate. Because let's be fair, you would not say something to someone's face that you would say behind a screen. Yeah. And that is the art form that has been lost, that needs to be found again, to get these two sides to actually have a conversation. And I think it would be better for society. It would heal society in the sense where you would get some comfort, and you'll have like, hey, this looting can't happen, and this is why. This burning can't happen, and this is why. And then you get the rejuvenation, because like we come full circle. What does housing get paid with? What does job training get paid with? Tax revenue. What are you losing when you burn down a business and the business doesn't doesn't come back, or you loot a business and they leave, you lose tax revenue. They're not going to pay their property tax, their sales tax. All of those things go away and go somewhere else. So there's a certain amount, and that's the thing that was picked up the best in that PBS special, was you're hurting your own community, and you don't want to do that. You want to support the community. You want to drive that home. And again, we need to have a conversation.
Well, I love it, and I love your work. If people aren't following, I certainly suggest you follow Mark Rossano. As you can tell, very thoughtful, very deliberate, looks at all the data, considers the angle, and what I love about conversations is conversations exposed when people are not educated on certain facts, and too many times people are weighing in on things they don't truly understand. And as you can see, every single issue has so much complexity, and you do so much work. I value your opinion so much. I appreciate and respect you, and I look forward to our next conversation. So thanks for joining.
Absolutely. Thank you, sir.
Okay, well, for everyone else, thank you for listening. Until next time, be safe, be good, have a great day, and bye for now.